subscribe to our channel, and press the bell icon to enjoy the videos.
Today we will talk about the market patterns, so let's get started. Number 1. Ascending triangle. An ascending triangle is a bullish chart pattern in technical analysis. It forms when there is a rising lower trend line and a flat upper trend line, creating a pattern that looks like a triangle tilted to the left. This indicates that while the price is making higher lows, it faces resistance at a particular level, preventing it from rising further. Traders often interpret an ascending triangle as a sign of accumulation, where buyers are consistently stepping in at higher prices. The breakout from the upper trend line is seen as a bullish signal, suggesting a potential upward price movement. It's important to consider other technical indicators and market conditions before making trading decisions based on any single pattern. Number 2. Descending triangle. A descending triangle is a bearish chart pattern characterized by a series of lower highs and a horizontal support line. It forms when the price of an asset consistently makes lower highs, indicating selling pressure, while the lows remain relatively constant, suggesting a strong support level. This pattern is typically considered a continuation pattern, signaling that the prevailing downtrend is likely to continue. Traders often pay attention to the breakout point, where the price breaches the horizontal support. A decisive move below this level may indicate a further decline in the asset's price. It's essential to consider other technical indicators and market conditions when interpreting chart patterns for more accurate predictions. Number 3. Down channel. In financial markets, a down channel pattern is a technical analysis concept that describes the price movement of an asset within a downward sloping channel. This channel is formed by drawing two parallel trend lines, one connecting the highs, resistance, and another connecting the lows, support. The price tends to move within these boundaries, indicating a downward trend. Traders and analysts use down channel patterns to make informed decisions about potential entry and exit points for trades. Breakouts from the channel, either to the upside or downside, can signal a potential change in trend direction. It's important to note that while technical analysis tools like channel patterns can provide insights, they are not foolproof predictors of future price movements, and other factors, such as fundamental analysis and market sentiment, should also be considered in making trading decisions. Number 4. Up channel. An upward channel pattern in the market is a technical analysis concept that depicts the price movement of a financial instrument, such as a stock or currency pair, within parallel lines sloping upwards. It consists of a series of higher highs and higher lows, forming a channel that suggests a bullish trend. Traders often use upward channels to identify potential buying opportunities when the price approaches the lower trend line, anticipating a bounce back towards the upper trend line. However, it's essential to consider other factors and use additional technical indicators to confirm trading decisions. Keep in mind that while technical analysis can provide insights, it's not foolproof, and market conditions can change rapidly. Always combine technical analysis with other forms of analysis and risk management strategies when making trading decisions. Number 5. A falling wedge. A falling wedge is a technical analysis chart pattern that typically signals a reversal in a downtrend. It forms when the price consolidates between two converging trend lines, with the upper trend line having a steeper slope than the lower one. This pattern resembles a wedge pointing downward. Traders often interpret a falling wedge as a bullish pattern. The decreasing volatility indicated by the converging trend lines suggests that sellers are losing strength, and a potential breakout to the upside may occur. However, it's essential to wait for confirmation, such as a clear upward breakout with increased trading volume. As with any technical analysis pattern, it's crucial to consider other indicators and factors before making trading decisions. Patterns are not foolproof, and risk management remains a crucial aspect of successful trading. Number 6. A rising wedge. A rising wedge is a technical chart pattern that can be indicative of a potential trend reversal. It is formed when the price of an asset creates converging trend lines, with both the support and resistance lines slanting upwards. The pattern resembles a triangle, but it slopes against the prevailing trend. Traders often interpret a rising wedge as a bearish signal. The narrowing price range suggests weakening buying interest, and the eventual breakdown below the support line could lead to a significant price decline. However, it's essential to confirm this pattern with other technical indicators and analysis to avoid false signals. Keep in mind that no single pattern guarantees future market movements, and technical analysis should be used in conjunction with other tools for a comprehensive understanding of market conditions. Number 7. A rectangle. In financial markets, a rectangle pattern is a technical analysis pattern that forms when the price of an asset trades within horizontal support and resistance levels. These levels create a rectangular-shaped pattern on a price chart. Traders often consider rectangles as a period of consolidation before the price either breaks out or breaks down. During a rectangle pattern, the market is in a state of indecision, with neither buyers nor sellers dominating. Traders typically look for a breakout above the resistance or below the support to make trading decisions. A breakout above the upper boundary could signal a bullish trend, while a breakdown below the lower boundary may indicate a bearish trend. It's important to note that technical analysis, including pattern recognition, is just one tool among many used by traders and investors, and it's not always foolproof. Market conditions can change rapidly, and other factors such as fundamental analysis should also be considered. Number 8. Head and shoulders. The head and shoulders pattern is a technical analysis chart pattern used in financial markets, particularly in stock trading. It consists of 3 peaks: a higher peak, head, between 2 lower peaks, shoulders. The pattern is considered a reversal pattern, indicating a potential change in the trend of an asset. Head. The highest peak in the pattern, representing a temporary peak in the price. Shoulders. 2 lower peaks on either side of the head. The left shoulder occurs before the head and is usually followed by a dip. The right shoulder comes after the head and is followed by a more significant dip, often mirroring the left shoulder. The neckline is a line drawn through the lows of the 2 trooks, forming the base of the pattern. When the price breaks below this neckline, it can signal a trend reversal from bullish to bearish. Number 9. Inverse head and shoulders. The inverse head and shoulders pattern is a bullish reversal pattern commonly observed in financial markets, especially in technical analysis of stocks and other securities. It typically consists of 3 lows: a lower low, head, between 2 higher lows, shoulders. The pattern is considered complete when the price breaks above the neckline, which is a line connecting the highs of the 2 shoulders. Traders often interpret the inverse head and shoulders pattern as a signal that a downtrend may be reversing and a new uptrend could be beginning. The psychology behind this pattern suggests a shift from bearish sentiment to bullish sentiment. The left shoulder represents an initial move downward, followed by a lower low, the head, and then a higher low, the right shoulder. The breakout above the neckline confirms the reversal. Number 10. Double top. The double top pattern is a technical analysis chart pattern that signals a potential reversal of an uptrend. It typically forms after an extended upward movement and consists of 2 peaks at roughly the same price level. The pattern is considered complete when the price breaks below the trough between the 2 peaks. Traders interpret the double top pattern as a sign that buying interest is waning, and it may be a precursor to a downtrend. The pattern is confirmed when the price falls below the support level, which is the lowest point between the 2 peaks. It's essential to note that technical analysis, including chart patterns like the double top, is not foolproof, and false signals can occur. Traders often use additional indicators and analysis to complement the interpretation of chart patterns and make more informed decisions. Number 11. Double bottom. A double bottom pattern is a technical analysis chart pattern that signals a potential reversal of a downtrend. It typically occurs after a prolonged downward movement in a financial market. The pattern is characterized by two distinct lows at roughly the same price level, separated by a temporary upward price movement known as the peak or trough. The formation looks like the letter W. Traders often consider the pattern confirmed when the price. Number 12, triple top. The triple top pattern is a technical analysis chart pattern that signals a possible reversal of an uptrend. It typically occurs after an extended price increase and consists of three peaks at nearly the same price level. The pattern is considered complete when the price falls below the support level, often located at the troughs between the peaks. Traders interpret the triple top as a bearish signal, suggesting that the prior upward trend may be losing momentum and a downward trend could follow. Confirmation of the pattern occurs when the price breaks below the support level, indicating a shift in market sentiment. It's important to note that, like any technical analysis pattern, the triple top should be used in conjunction with other indicators and analysis tools for more robust decision-making. Patterns in financial markets are subject to interpretation and can be influenced by various factors, so it's crucial to consider the broader market context. Number 13. Triple bottom. The triple bottom pattern is a technical analysis chart pattern that signals a potential reversal of a downtrend. It consists of three troughs or lows at roughly the same price level. Traders often interpret this pattern as a strong indicator that an asset's price may move upward after a prolonged decline. The pattern suggests that the bears, sellers, have tried to push the price lower on three separate occasions but have failed, indicating a potential shift in market sentiment. Traders typically look for a confirmation of the reversal when the price breaks above the resistance level that forms between the peaks of the three bottoms. As with any technical analysis pattern, it's essential to consider other indicators and factors before making trading decisions. False signals can occur, so risk management and additional analysis are crucial. Number 14. A bearish flag. The bearish flag pattern is a technical analysis chart pattern that can signal a potential continuation of a downtrend in a financial market. It typically occurs after a strong downward price movement and consists of two main components: a sharp, nearly vertical drop, flagpole, followed by a consolidation period, the flag, that slopes against the prevailing trend. Traders often interpret the bearish flag as a temporary pause or consolidation before the price resumes its downward movement. The pattern is characterized by declining trading volumes during the flag formation. The breakout from the flag typically occurs in the direction of the initial trend, leading to a renewed downward movement. It's important to note that while chart patterns can be useful tools, they are not foolproof indicators, and other factors should be considered in the overall analyses of the market. As with any trading strategy, risk management and thorough analyses are crucial. Number 15. A bullish flag. A bullish flag pattern in the market is a continuation pattern that typically occurs after a strong upward price movement. It is considered a bullish signal, suggesting that the previous uptrend is likely to continue after a brief consolidation or pause. The pattern is characterized by two main components. 1. Flagpole. This is the initial strong upward price movement that precedes the flag pattern. It represents a rapid increase in buying interest. 2. Flag. After the flagpole, there is a rectangular-shaped consolidation or retracement in prices, forming what looks like a flag. This phase involves a mild downward or sideways movement in prices. Traders often look for the following characteristics to identify a bullish flag pattern. Flag shape. The flag should have a rectangular shape, indicating a pause in the market trend. Volume. During the flag formation, there is typically a decline in trading volume. This reflects decreased enthusiasm or participation in the market during the consolidation phase. Breakout. The pattern is considered complete when prices break out of the upper boundary of the flag, resuming the prior upward trend. Target. Traders often use the flagpole's length as a measure to estimate the potential price target once the breakout occurs. It's essential to note that while the bullish flag pattern is a useful tool for technical analysis, no pattern guarantees future market movements. Traders often use additional indicators and analysis to confirm signals and manage risk effectively. Number 16, a pennant. A pennant is a technical analysis pattern that resembles a small symmetrical triangle. It forms after a strong price movement, indicating a brief consolidation before the previous trend resumes. The pennant is characterized by converging trend lines, where the price consolidates within decreasing highs and increasing lows, forming a small symmetrical triangle shape. Traders often interpret a pennant as a continuation pattern, suggesting that once the consolidation phase is complete, the initial trend is likely to resume. The breakout direction is usually the same as the direction of the preceding trend. Traders use pennant patterns, along with other technical indicators, to make informed decisions about potential entry or exit points in the market. As with any technical analysis tool, it's essential to consider other factors and use risk management strategies when making trading decisions.